You know, when most people hear the words real estate investing, I feel like their brain immediately goes to, one very specific, very stressful place.
Oh, absolutely. The reality TV version.
Right. Exactly. You picture buying this totally rundown house,
Hmm.
spending your entire weekend covered in drywall dust, and just hemorrhaging cash at Home Depot.
Yeah, and just praying you can flip it for a profit before the holding costs eat you alive, right? It's uh it's a grind.
It is a massive grind, and it requires hundreds of thousands of dollars in capital or, taking on crazy debt just to even step onto the playing field.
Right. Which is exactly why so many people just sit on the sidelines. They think they can't afford to play the game.
Well, today we are completely bypassing all of that noise.
Hmm.
And I want to take a second here. If you were one of the, I think it's 10 or 12 new investors joining us today from the Liberation League School community, welcome.
Yes, welcome to the deep dive. We are thrilled you're here.
We really are. And this deep dive is custom built as your starting line. Because we're diving into a totally different philosophy of real estate today, based on John Sneed's book. He goes by J. Sneed, and it's called The Forever Paycheck: Building Wealth the Warren Buffett Way.
It's honestly, it's the perfect foundational text for the Liberation League. Because what we're going to unpack today, it really requires a fundamental shift in how you view wealth.
Yeah, explain that a bit. What's the shift?
Well, we aren't just talking about picking stocks here. We are talking about buying back your time. It's moving away from what Snead calls the miseducation of money, where you're just constantly trading your physical hours for a paycheck and stepping into the liberation of making your money serve you.
I love that.
Right. The goal is to build a built-in retirement check that arrives in your bank account, whether you decide to get out of bed in the morning or not.
Okay, but let me just pause you right there
Go.
because we need to clear something up immediately for the listener.
Yeah, go for it.
If we aren't defaulting to flipping houses,
Yeah.
right, and we aren't saving up a massive down payment to buy a whole apartment building, how exactly are we getting this real estate money?
Right, the mechanics.
Yeah. I know the core of Sneed's strategy revolves around something called a REIT, R-E-I, a real estate investment trust. But walk us through how this actually works for the everyday investor.
So, at its simplest, a REIT is a company that owns, operates, or finances income-producing real estate. And you buy shares of it right on the stock market, just like you would buy, shares of Apple or Amazon.
Okay, so it's totally accessible.
Completely. But the absolute magic of a REIT, like the underlying engine that makes this entire forever paycheck concept possible, is this legal requirement known as the 90% rule.
The 90% rule. Okay, what is that?
By law, for a company to actually qualify as a REIT and avoid paying corporate income tax, they are legally obligated to pay out at least 90% of their taxable income to their shareholders in the form of dividends.
Hold on a second. I need to challenge that because
No, it sounds crazy.
it does. From a business perspective, that sounds completely counterintuitive. I mean, if a company is legally forced to give away 90% of its profits every single year, how on earth do they have any money left to buy new properties or fix roofs or just grow?
That is exactly the right question to ask. And it's kind of the paradox of the REIT model.
Because it sounds like a terrible strategy that would just stagnate, really.
It does, but here's how it actually works. Because they can't retain their earnings to fund growth, they have to constantly raise outside capital. They do this by issuing new shares of stock or taking on debt.
Okay, but why would anyone keep giving them money if they give all their profits away?
The answer is that massive, legally mandated dividend. By offering investors this highly attractive, reliable cash payout, they create a constant line of eager investors who are more than willing to fund their next property acquisition.
Oh, wow. Okay, I see.
Yeah, it's a beautifully calibrated cycle. They buy a property, the rent increases their income, they pass 90% of that new income to you, which makes their stock more attractive, which allows them to raise more capital to buy the next property.
Okay, when you explain the mechanics like that, it actually makes total sense. It's essentially, it's crowdsourcing a real estate empire.
Exactly.
And honestly, from the investor's perspective, it sounds like having a magical property manager. I mean, you have a team of professionals doing all the market research, securing the loans, negotiating with tenants, and doing it all for free from your point of view. You just sit back and collect the rent.
Right. And most importantly, for the Liberation League, you completely avoid what real estate veterans call the three T's.
Oh, the three T's. Yes.
Yeah.
The tenants, the toilets, and the trash.
Exactly.
Yeah.
There is absolutely no 2.00 a.m. phone call because a water heater exploded and flooded a basement. You are simply collecting the check.
That is the dream.
Yeah.
But let me play devil's advocate for the group for a second. If I'm a new investor and I'm used to the idea of a physical house, something I can drive by, touch, put a lock on the front door, is a REIT actually as safe? Like, what exactly are we owning here if we just buy a ticker symbol on a computer screen?
Well, it really comes down to two major advantages over physical real estate: liquidity and tangible asset quality.
Okay, break that down.
Think about a physical rental property. If you suddenly need your money out of that house because of, I don't know, a medical emergency, you are looking at months of staging, listing, negotiating, closing all, while paying massive realtor fees.
Right, it's totally illiquid. You're trapped.
Exactly. But with a REIT, you have total liquidity. You can sell your units in 2 seconds on the open stock market if you need to.
Okay, that's a huge point.
And to answer your question about what you're actually owning, you just have to look right through the ticker symbol to the underlying assets. You aren't just buying digital paper. You're buying fractional ownership of massive, highly tangible commercial properties.
So let's make this incredibly tangible for the listener right now. Let's look at the defensive anchor of this entire strategy that Snead talks about.
The first Paycheck player.
Right, the very first Paycheck player he introduces is Realty Income, and they trade under the stock ticker O, just the letter O.
Yeah.
And they're so confident in their model that they actually trademarked the phrase, the monthly dividend company.
Which is quite the flex in the financial world, honestly, but they back it up with the assets they hold.
They really do. When you buy shares of O, you are instantly becoming a part owner of the land underneath over 15,000 commercial properties. And these aren't obscure abandoned warehouses on the outskirts of some random town.
No, not at all.
You are essentially becoming the landlord for your own neighborhood. We're talking about incredibly recognizable retail properties here. Their largest tenant is 7-Eleven.
Yep.
They lease to Walgreens, CVS, Dollar General, Dollar Tree, LA Fitness, BJ's Wholesale Club. You are literally owning the very ground these massive recession-resistant brands operate on.
And what's truly fascinating here isn't just who they lease to, but how they structure those leases. Because this is where the Realty Income business model becomes practically bulletproof.
Like lease structure.
Yeah, they rely heavily on something called a triple net lease.
Oh, please break down the mechanics of a triple net lease for everyone, because when I first read about this in the book, it absolutely blew my mind how heavily the deck is stacked in the landlord's favor.
It really is. So let's compare it to a standard residential lease, right? If you rent out a house to someone and the roof leaks or the city suddenly raises the property taxes, you, the landlord, take the financial hit.
Right, your profit margin just shrinks.
Exactly. But in a commercial triple net lease, the tenant, so let's use Walgreens as our example, they take on virtually all the risk. Walgreens is responsible for paying the property taxes, they pay the building insurance, and they cover all the structural maintenance.
Wait, really? All of it?
All of it. If the HVAC system breaks down in the middle of July, Walgreens pays to fix it. If the local property tax skyrockets, Walgreens pays the difference. Realty Income's primary job is simply to collect the base rent and pass it on to you, the shareholder.
That is the ultimate hands-off business. I mean, their overhead must be incredibly low, which totally explains their track record.
Oh, the track record is phenomenal.
The stats on Realty Income are just wild. Based on the sources, they sit at a yield of around 5.0 to 5.1% right now, and they pay out roughly 27 cents per share every single month. But here's the crazy part. They have declared over 660 consecutive monthly dividends.
Think about how many market crashes happened during that time.
Right, and they've had over 25 years of consecutive dividend increases. So just by holding the stock, they're essentially giving you a pay raise every single quarter.
And if we connect this back to the mindset shift for the Liberation League, I'd actually pose a question to everyone listening right now.
Go for it.
If you could own the land underneath one business you visit every single week, maybe it's your local grocery store or your gym or the pharmacy where you pick up your prescriptions, which one would it be?
That's a great question to ask yourself.
Because that mindset is the foundation of the forever paycheck. You are making a psychological transition from being just a consumer handing your money over the counter, to being the actual owner of the ground those consumers are walking on.
That is such a powerful way to look at it. Okay, so Realty Income is our anchor. It's safe, it's steady, it's the foundation of the house. But I have a little bit of a math problem here.
Okay, let's hear it.
A 5% yield is great for stability, right?
Mm-hmm.
But if I'm trying to replace my salary and build a built-in retirement check, 5% is going to take a very long time. It's a little too slow. How do we safely speed this up and get more cash flowing into the account?
That brings us to the next category of the portfolio. Because to accelerate the yield, Snead suggests looking outside of traditional brick-and-mortar property ownership and utilizing the financial mechanics of real estate. Enter the mortgage REIT, or M-REIT.
Okay, REITs.
Yeah, and the prime example the book highlights is AGNC Investment Corp.
Right, so just to be totally clear, instead of owning physical buildings like Realty Income does, AGNC owns the paper. They invest in residential mortgages.
Correct.
But how do they generate such massive yields? We are talking typically in the 13.7 to 14.3% range, paying around 12 cents a share monthly. Where does that double-digit return come from if, standard mortgage rates are nowhere near 14%?
It comes entirely from the mechanics of leverage. Here's how you can visualize it. Imagine you could borrow $1 million from a very wealthy friend at, let's say, a 3% interest rate.
Must be nice to have a friend like that.
Right. But you take that entire $1 million and immediately deposit it into a high-yield savings account that pays you 5% interest.
Okay, I follow.
You aren't doing any work, but you are pocketing the 2% difference between what you owe your friend and what the bank is paying you. That difference is called the spread.
Right, the spread.
AGNC does this exact same thing, but on a massive institutional scale. They borrow billions of dollars at really cheap short-term rates, and they use that money to buy long-term residential mortgages that pay a higher interest rate.
I see.
So by applying immense leverage, they turn a tiny 1 or 2% interest margin into a huge double-digit yield for their investors.
No, hold on. Because I know exactly what everyone listening is thinking right now, because my brain immediately flashed red too.
The 2008 crisis.
Yes. You say leverage and residential mortgages in the same sentence. And we all instantly think of 2008.
Right.
People defaulting on loans, toxic paper, the whole system just totally collapsing. How is this not just walking into the exact same trap?
It is the absolute right question to ask, and it's why understanding exactly what you own is so paramount here. The safety net with AGNC lies entirely in the specific kind of mortgages they are buying.
Okay, what kind are they?
They almost exclusively invest in what are called agency residential mortgage-backed securities.
Okay, I'm going to need an explain. I'm 5 on what agency debt actually means in a worst-case scenario.
Sure. So in 2008, people defaulted on subprime mortgages, right? And the paper became completely worthless, bankrupting all the funds that held it. But with agency debt, the principal and interest payments are actually guaranteed by U.S. government-sponsored enterprises, primarily Fannie Mae and Freddie Mac.
Wait, guaranteed by the government?
Yes. So, in plain English, if a homeowner loses their job and stops paying their mortgage, the U.S. government essentially steps in, buys that bad mortgage back out of the pool, and hands AGNC their principal back.
Wow.
Uncle Sam basically acts as the ultimate insurance policy. Because of that guarantee, the credit risk, like the risk of the borrower defaulting, is practically zeroed out.
Okay, well, that changes the picture completely. If the government is guaranteeing the principal, the default risk is gone. But let's look at the mechanics of their leverage model again, because you said AGNC relies on borrowing money at cheap short-term rates to fund long-term loans.
Right.
But what happens when inflation spikes and the Federal Reserve jacks up interest rates to cool the economy down? Doesn't their short-term borrowing suddenly become incredibly expensive and completely destroy their profit spread?
Spot on. You nailed it. That is the exact vulnerability of an M-rate. While they have virtually zero credit risk, they have massive interest rate risk.
Okay.
When the Fed raises rates quickly, AGNC's borrowing costs go up way faster than the income they receive from their older fixed-rate mortgages. The spread gets crushed, and their stock price drops. It can be a very volatile roller coaster.
Which means relying entirely on AGNC to accelerate our paycheck is a massive blind spot if inflation returns. We need a way to protect the portfolio from the Fed raising rates. So how do we solve that?
That is exactly why Snead introduces the third pillar of this strategy, the inflation fighter.
The inflation fighter. I like the sound of that.
Yeah, and this is Pennant Park Floating Rate Capital. The ticker symbol is PFLT. Now, technically, this isn't a traditional real estate REIT. It's what's called a business development company, or BDC, but it operates like a REIT for corporate America.
So instead of lending money to home buyers, PFLT acts as a private lender, providing capital to mid-sized private companies all across the United States.
Exactly.
And the mechanic that solves our inflation problem is right there in their name, right?
Yeah.
Floating rate. Walk us through how that protects the investor.
So if you're building a forever paycheck, your biggest silent enemy is inflation eroding your buying power. With PFLT, the interest rates on the loans they give out to these companies are not fixed, they are floating, meaning they're legally tied to broader market rates. So, if the Federal Reserve raises interest rates to fight inflation, PFLT's borrowers are contractually obligated to pay more interest. PFLT actually generates more income during high-rate environments, which means they turn around and pay you, the shareholder, a larger dividend. It's a built-in hedge.
That is brilliant. So when traditional stocks are getting absolutely crushed by rate hikes, PFLT is actually getting a pay raise.
Precisely.
And they boast a massive yield, too,
Oh.
around 14.5 to 14.7%, paying just over 10 cents a share monthly. But let me ask about the risk here. With AGNC, we had the U.S. government guaranteeing the loans. We do not have that with corporate loans.
No, we don't.
So what happens if one of these mid-sized companies just goes bankrupt? Do we just lose that money?
Well, PFLT protects its downside by focusing almost exclusively on first lien secured debt.
First lien secured debt. What does that mean?
This isn't just, a corporate IOU written on a napkin. Secured debt means the loan is literally backed by the physical assets of the borrowing company, their real estate, their factory machinery, their intellectual property.
Oh, I see.
And first lien means that if the company goes bankrupt, PFLT is legally first in line at the courthouse. They have the absolute right to seize those physical assets, sell them off, and recover their investors' money before any other creditors get a single dime.
Okay, so we have Realty Income for the steady physical foundation. We have AGNC to aggressively accelerate the cash flow using leverage. And we have PFLT to protect us when interest rates spike. That seems like a perfectly balanced triad right there.
It is a great core.
But Sneed's sources mention one more ticker. The wild card.
Ah, yes. Oxford Lane Capital, or OXLC.
I see the yield on this one, and my jaw is basically on the floor. We are talking often 18 to 20%, sometimes even 24% or more. It sounds almost too good to be true.
It's definitely an eye-catcher.
The sources call this a closed-end fund investing in CLOs, collateralized loan obligations. I need you to stop right there and explain what a CLO is, because I guarantee you most people listening have never heard of it.
It's true. A CLO is a highly complex financial instrument, so let's use an analogy to make it simple.
Please do.
Imagine taking hundreds of different, slightly risky corporate loans and putting them all into a giant financial blender. You blend them all up, and then you pour that mixture into different cups stacked on top of each other in a pyramid.
Okay, a pyramid of cups.
Right. These cups are called tranches. The cup at the very top of the pyramid gets paid back first whenever the loans generate interest. Because it's the safest cup, it pays the lowest yield.
Makes sense.
But the cup at the very bottom of the pyramid only gets paid after everyone else above them has taken their cut. If some of those loans in the blender default, the bottom cup absorbs the losses first.
Ouch.
Yeah. Because they are taking on the most risk, they demand an astronomically high yield. OXLC's entire business model is buying those high-risk, high-reward bottom cups.
Wow. Okay, so this raises a huge red flag. A 24% yield is clearly not a free lunch. If they're absorbing the losses first, this has to be incredibly volatile.
It is extremely volatile. This is an important moment to temper the excitement with a dose of reality. OXLC is significantly riskier than anything else we've discussed today. Can it turbocharge the compounding effect of a small portfolio? Absolutely. But it is aggressive growth. It requires a much more hands-on approach to monitor, and it absolutely must be anchored by the sleep well at night stability of your core positions like Realty Income. You do not build your entire house out of wild cards.
A very vital warning. Okay, so we have our 4 tickers. We know the mechanics of how they generate cash, but how does the listener take these symbols and actually assemble a retirement check?
The action plan.
Right, because Sneed outlines a very clear action plan, and the math on this is arguably the most compelling part of the entire strategy.
It is. So step 1 is the accumulation phase. And the crucial mechanism you must activate is your DRP, your dividend reinvestment plan. When you buy these shares through your brokerage app, you literally just check a box that says reinvest dividends. It is entirely set it and forget it.
Warren Buffett famously calls this compound interest on steroids. Let's walk through the mechanics of why that is.
Go for it.
Instead of taking that, say, 12-cent dividend for AGNC and putting it in your pocket, your brokerage automatically uses that cash to buy tiny fractional shares of the same stock.
Yeah.
So by the end of month one, you own slightly more shares than you started with, which means in month two, your dividend check is slightly bigger. That bigger check buys even more fractional shares, which generates an even bigger check in month three.
It creates an automated snowball effect that just accelerates month over month, year over year, without you ever having to ask your boss for a raise or work extra hours at a day job.
But we have to be incredibly honest about the psychology of this process here, because this is where almost all new investors fail.
Yes, the slow motion start.
The slow motion start. This is the hardest part. Let's look at the actual math Snead provides. Let's say you start with a $5,000 initial investment, and you commit to adding $500 a month out of your own paycheck. Assuming a realistic 10% overall return and a conservative 5.5% dividend yield across the portfolio, in year one, your estimated monthly paycheck from this setup is exactly $54.
Right. $54.
You cannot retire on $54. You can barely take your family out to a casual dinner on $54. And this is exactly where most people quit. They look at their brokerage account, they feel the pain of sacrificing $500 of their hard-earned money every month, and they think, this is pointless, it's moving too slow, I'd rather just go buy a TV.
It's human nature.
It is. So to the Liberation League listening right now, your primary overarching mission is to survive the boredom and frustration of year one. Because if you hold the line, the map eventually goes exponential.
That is the raw power of the compounding engine. If you survive that slow start and keep that DRIP running, fast forward to year 10, using that exact same strategy, $5,000 to start, $500 a month in contributions, your portfolio balance crosses $116,000, and your monthly passive paycheck is now generating $535.
And I really want everyone to notice what just happened mechanically at that year 10 mark. That is the tipping point. You are contributing $500 a month from your physical labor, but your portfolio is now generating $535 a month completely on its own.
Your money is officially working harder than you are.
Exactly. The snowball is now so large it is pushing itself down a hill. By year 15, that monthly dividend check jumps to over $1,060 a month, and it just keeps accelerating.
And there is a critical pro tip we really need to insert right here regarding the tax mechanics, because this can eat your snowball alive if you aren't careful.
Oh yes, the taxes.
Remember how REITs and BDCs avoid corporate taxes by passing 90% of their income to you? Well, the IRS doesn't just forget about that money. They tax those dividends at your ordinary income tax rate.
Ouch.
Yeah, so if you build this portfolio in a standard taxable brokerage account, you are going to be slammed with a hefty tax bill every single year on money you were just trying to reinvest anyway.
So how do we legally shield this income so the snowball doesn't just get taxed to death?
You build the specific dividend portfolio inside a Roth IRA. If you buy Realty Income, AGNC, and PFLT inside a Roth account, all of that massive decade-long compounding happens 100% tax-free.
That is huge.
And better yet, when you finally hit retirement age and start pulling that forever paycheck out to buy groceries and pay your mortgage, every single dollar is entirely tax-free income.
That is an unbelievable advantage, which really brings us to the final steps. The finish line, the flip the switch moment.
The best part.
You set up the DRP, you automate the $500 a month transfer so you never even see the money leave your checking account, and you wait. You let the compound interest do the heavy lifting. And then, years down the line, you look at your portfolio and you realize that your total monthly dividend income finally equals your total monthly living expenses.
That is the very definition of financial liberation.
At that exact moment, you log into your brokerage account, you go to your settings, and you simply uncheck the DRP box. You flip the switch. Instead of reinvesting, you tell the brokerage to route that cash directly into your local checking account. You are now living entirely off the rent generated by thousands of commercial properties, government-backed mortgages, and corporate business loans. You are officially retired, and the beautiful part is, you never even had to sell a single share to do it. The principal balance of your portfolio remains untouched, continuing to generate wealth.
If we pull back from all the tickers and the math for a second, the core philosophy of what John Snead is teaching here is just profoundly empowering. Every single share you purchase of these companies is like hiring a tiny, tireless employee.
I love that analogy.
Right. They don't complain about the air conditioning. They don't ask for vacation days. They don't call in sick on Mondays. They simply work 24 hours a day, 7 days a week, utilizing complex financial machinery to generate capital, and they send you a rent check every single month.
It really fundamentally changes how you look at the world around you. And I want to leave you, the listener, with a final provocative thought to mull over today.
Leave them with something good.
The next time you walk into a Walgreens to buy toothpaste, or you pull your car into a 7-Eleven to get gas, take a second to look down at the tile floor beneath your feet. Ask yourself, am I content just being a consumer in this transaction? Or could I be the landlord collecting rent from every single purchase happening above this tile?
That changes everything.
Look closely at your budget today. Find that first $100. Don't spend it on something that is just going to immediately lose its value. Hire your first mini-employee and start the snowball.
Start the snowball.
Before we sign off, I want to give a massive special thanks to the Wealth Builders Mastermind Group for making this community possible and for bringing this vital real estate information to light.
Truly, thank you.
If you're tired of the grind, ready to stop trading your physical time for dollars, and want to join this investing ownership movement, you need to visit wealthbuildersmastermindgroup.com. Thank you so much for joining us on this deep dive. Now go get that forever paycheck.